In the past 3 months, the Magnificent Seven stocks are down significantly, with Meta being an exception, bolstering a plus 2%. In today's video, I'm going to show you the 2 best Magnificent Seven stocks to buy the dip with and capitalize on this opportunity, as well as if you should consider waiting to buy even lower prices, and why the Magnificent Seven stocks are down with the rest of the market. Tesla is down the most out of the 7 at minus 33%. Nvidia is down the second most at minus 19%. Yes, each one of these individual companies have reasons as to why they are down, but it's also important to consider the broader economic and market conditions. For example, the bank Barclays has reduced its 2025 year-end forecast for the S&P 500 to 5,900. This is down more than 10% from its prior estimate of 6,600. Citing the risk of U.S. tariff actions weighing on the economy. If you don't know exactly what that means, SPX currently sits at around 5,700. Barclays previously had a target of about 6,600. Now, by year's end, they expect it to be around 5,900, which is more than a 10% decrease. Here is a bar graph chart that shows all of the Wall Street banks' forecasts for the SPX year-end target. We have Oppenheimer with the highest SPX target of 7,100. Since SPX is currently at about 5,700, that accounts for about a 25 to 30% upside. The lowest target being for Stifel, which is 5,500. This graph here visualizes it a little bit. We have Oppenheimer here with the highest price target for SPX, and that is at 7,100. Then we have Stifel at the lowest. As you can see, it's about a 2 to 3% downside. Here we can see Barclays revision, and now it's at 5,900. But the point is that most banks still expect S&P 500 to go up by year's end. In this article about the Magnificent Seven, Morgan Stanley talks about how they see the mega cap tech group restoring U.S. stock dominance. In summary, the sell-off in Magnificent Seven stocks may be over. A rebound in the mega cap tech group could put U.S. markets back on top. U.S. stocks saw the biggest weekly inflow so far in 2025 last week, with investors pouring a net $34.1 billion into U.S. stocks. This chart shows us here that relative to the rest of the market, the Magnificent Seven are actually cheaper. If we look at a forward 12-month price-to-earnings ratio valuation, the Magnificent Seven are currently only 77% of the 20-year mean. Meanwhile, the other 493 stocks that make up the S&P are 89% of their 20-year mean. So, compared to the 20-year mean, the Magnificent Seven trade 23% cheaper on a forward 12-month price-to-earnings ratio valuation. Let's start to take a look at the individual stocks in the Magnificent Seven to understand whether you should buy now or wait for a bigger dip so you can buy at a lower price. Let's take a look at some of the valuation metrics. So right now, valuation NTM. NTM means next 12 months. So it takes the projections and the estimates of the earnings and revenue over the course of the next 12 months and makes the valuation on that basis. So the PE for the next 12 months is currently 25.1. Some may consider a forward PE of 25.1 to be kind of expensive, but the estimates say otherwise. If we take a look at the revenue consensus analyst estimates, Nvidia's revenue is expected to grow by 58.1% in 2026 and 23.5% in 2027. Now, this is coming from a lot of analysts. There are a total of 55 different analysts making estimates for Nvidia, so they tend to be fairly accurate. Of course, these revenue estimates are always subject to change, but there's a chart here of the revision trends, and as we can see, every single time the mean revenue estimate has increased. Now let's go ahead and take a look at the price targets for Nvidia from analysts. Now, 46 of the analysts say buy, 11 say outperform. Outperform just means they think it'll outperform the rest of the market and go up more than the rest of the market. 5 of them say hold, 9 say no opinion. Now the price target means what an analyst thinks the price will be at about a year from now. And the lowest price target out of all these covering analysts, which is 71 analysts, is $125 per share. Now out of these 71 analysts, not a single one of them think that Nvidia's price per share will be down 1 year from now. They all account for at least 10 to 15% upside. The average price target is $171 per share, and the highest price target is $220 per share. Now, of course, these price targets can always change, and that has happened, so we can take a look at the revision trends. The peak of the average price target per share was somewhere in January at about $174 per share and 51 cents, and now it sits at about $171. So it has gone down a little bit, but I attribute that just to the overall market downturn. Now guys, let's take a look at the free cash flow metric. This is one of my favorite metrics to look at because it just shows how much money the business went home with at the end of the year, which they can use for expanding the business, investments, and paying shareholders like us. In 2023, the free cash flow was $3.8 billion. In 2024, it was $27 billion, and in 2025, $60.9 billion. Now, this is amazing because their free cash flow has been growing at insane rates. And if we turn on estimates all the way up to the year of 2028, we can see that it just continues to climb at incredible rates. I mean, in 2026, the free cash flow will be $98 billion, while in 2025, it was $60.9 billion. So that's over a 50% increase. Then in the year 2027, it's $128 billion. Then in 2028, $144 billion. Now, of course, it's very important to remember that these are estimates. However, if NVIDIA does execute on these estimates, it's most likely going to pass way above $109 per share. Now, one of the main reasons NVIDIA's stock has fallen so much in the last couple days is because the main chip that it sells in China no longer meets the new energy efficient regulations. China's top economic planner, the National Development and Reform Commission, has introduced energy efficiency rules for advanced chips. Those rules would disqualify NVIDIA's H20 chip from use by Chinese customers. Now, China's sales accounts for roughly 13% of NVIDIA's entire revenue stream, so people see this as a major threat. However, there is zero doubt in my mind that NVIDIA just makes the required adjustments to the chip so that it now meets the energy efficiency rules. With NVIDIA being as big of a company as it is and being around for as long as it has been, it's not going to let its China's revenue stream just fade away. Now, one of the main reasons that I love NVIDIA as an investment is that they're very focused on humanoids and robotics. I think that humanoids and robotics will be the product with the biggest total addressable market that the planet has ever seen. Now, one thing NVIDIA is doing to help the advancement of humanoids and robotics is that they released Isaac GR00T N1, which is the world's first open humanoid robot foundation model. Pretty much every humanoid and robotic system that is being utilized in real world scenarios right now is running off of this Isaac GR00T. If I consider everything, I think NVIDIA is at a wonderful buy the dip opportunity spot. However, that doesn't mean to just take all the cash you have available and buy every piece of NVIDIA you can. I would keep some cash on the side just in case NVIDIA does continue to dip lower to somewhere around like $90 per share. If it does and you still have cash on the side, then you can buy much more at a lower price. Now that I've showed you how good of an opportunity it is to buy this dip on NVIDIA right now, there are a couple other opportunities in the Magnificent Seven that you have to see. Next up, let's take a look at Amazon. So for the valuation metrics, its forward PE is currently 31.7. Now this is kind of high, right? Because if we look at the margins, they're not nearly as good as something like NVIDIA. The net income margin is only 9.3%. So why don't we take a further look into the estimates and see if this PE is justified. So if we take a look at the revenue consensus estimates, Amazon's revenue is supposed to grow 9.7% in 2025, 10.3% in 2026, and 9.8% in 2027. Now that's not nearly as much as NVIDIA's. So let's take a look at the EPS growth estimates as well, which is the profitability side of things. Here we see that in 2025, it's supposed to grow 23.3%, 2026, 19.6%, and 2027, 25.1%. According to these estimates, there should be some significant improvements in the EPS side of things and profitability for Amazon. Let's take a look at the price targets from analysts as well. 46 analysts say to buy, 19 say Amazon will outperform the rest of the market, 3 say hold, and 2 say no opinion, with no analyst saying that it'll underperform and no analysts say to sell. Now the lowest price target that is set a year from now is $203 per share. The average price target for Amazon is $265 per share and the highest is $306. Let's take a look at the price target revisions, and clearly it's gone up significantly over time, with the peak being around $266 per share, making its way down to about $265. This decrease can be attributed to broader market downturns. Now, there is clearly quite the divergence between the stock price and the average price target from analysts. The stock price goes down quite a lot, while the price target goes up and stays the same. Every time that this has happened in the past 2 years, Amazon's stock price makes its way back up to the average analyst price target. So some may see this as a good buying opportunity. Now, if we go ahead and take a look at the free cash flow side of things, which is again one of my favorite metrics to look at, Amazon has recovered from a dip in their free cash flow in 2021 and 2022, recovering back up to $32.9 billion in free cash flow in 2024. Now, if we take a look at the estimates all the way up to the year 2027, we can see Amazon's free cash flow start to accelerate with $109 billion in free cash flow in 2027. Now, this is attributed to the estimation in the profitability side of things for Amazon getting a lot better. Now, one reason analysts estimate that the profitability side of things will get better for Amazon is because of robotics replacing people like fulfillment workers. Novak says if 30 to 40% of Amazon's US units were fulfilled through next generation robotics enabled warehouses by 2030, it could lead to $10 billion plus of savings. Personally, I think this will be more. This analyst who sees the potential with robotics says that they have an overweight on Amazon stock with a $280 price target. Amazon stock currently trades at $228. That was at the time of this article. Now Amazon's trading at about $198. All things considered, I would be buying this dip lightly on Amazon, definitely not as much as Nvidia. For Amazon, I would wait for a larger drawdown to buy more. There you have it, guys. Those are my two favorite Magnificent 7 stocks to buy with this dip. However, I would definitely hold cash on the side in case we keep going down. If you enjoyed the video, subscribe and leave a comment. I'll see you all in the next one. Peace.